On December 23, 1913, President Woodrow Wilson signed into law one of the most consequential pieces of legislation in American history, the Federal Reserve Act. With the stroke of a pen, the United States finally established a central banking system after more than a century of financial chaos, bank runs, and economic panics. But this wasn't a story of careful planning or unanimous agreement. The creation of the Federal Reserve was born from crisis, shaped by political warfare, and engineered through one of the most secretive meetings in financial history. This is the story of how America's central bank came to be and why it matters more than ever today. To understand why the Federal Reserve was created, we need to go back to the late 19th and early 20th centuries, when the American financial system was fundamentally broken. Unlike other major industrialized nations, the United States had no central bank. There was no lender of last resort, no coordinated monetary policy, and no institution capable of stabilizing the banking system during times of crisis. The country had tried central banking twice before. The first Bank of the United States operated from 1791 to 1811, and the second bank from 1816 to 1836. Both were killed by populist opposition, particularly from President Andrew Jackson, who viewed concentrated banking power as a threat to democracy. So America entered the industrial age with a fragmented banking system. Thousands of banks operated independently across the country, each issuing its own currency. There was no mechanism to move money quickly between regions, no way to inject liquidity during panics, and no safety net when banks failed. And fail they did, repeatedly. The Panic of 1873 triggered a 6-year depression. The Panic of 1893 saw over 500 banks collapse. The Panic of 1907 was perhaps the worst of all. It started in October when the Knickerbocker Trust Company, one of New York's largest financial institutions, collapsed after a failed attempt to corner the copper market. Panic spread like wildfire. Depositors lined up around blocks to withdraw their money. Banks that were perfectly solvent one day found themselves insolvent the next, simply because they couldn't convert their assets to cash fast enough to meet the stampede of withdrawals. The entire American financial system teetered on the edge of collapse. There was no Federal Reserve to provide emergency loans, no deposit insurance to calm depositors, no coordinated response from government authorities. What saved the system was one man, J.P. Morgan. At 70 years old, Morgan essentially became America's central bank. He locked the nation's leading bankers in his library and refused to let them leave until they agreed to pool their resources and provide emergency funding to failing institutions. He personally directed which banks would be saved and which would be allowed to fail. He strong-armed wealthy individuals into depositing funds into shaky institutions. He even convinced John D. Rockefeller to pledge half his fortune to shore up the system. It worked. The panic subsided. But the message was clear and terrifying. The world's largest economy had just been saved by a single private citizen. What would happen when J.P. Morgan was no longer around? What if next time no one had the resources or the will to step in? Senator Nelson Aldrich of Rhode Island captured the mood perfectly when he said, "Something has got to be done. We may not always have a J.P. Morgan with us to meet a banking crisis." The question wasn't whether America needed banking reform. The question was what form that reform would take. In November 1910, a group of men boarded a private railway car at a small station in New Jersey. They travelled under assumed names and pretended to be going on a duck hunting trip. Their actual destination, Jekyll Island, Georgia, a private resort owned by some of America's wealthiest families. This wasn't a vacation. It was one of the most secretive and important meetings in American financial history. The men represented roughly 1/4 of the world's wealth. There was Senator Nelson Aldrich, the powerful chairman of the National Monetary Commission. Frank Vanderlip, president of National City Bank, the largest bank in America. Henry Davison, a senior partner at J.P. Morgan and Company. Charles Norton, president of First National Bank of New York. Benjamin Strong, representing J.P. Morgan's interests. And Paul Warburg, a partner at Kuhn, Loeb and Company, and arguably the most important person in the room. Warburg was a German immigrant who had worked in European banking and understood how central banks functioned. He had been advocating for American banking reform for years, writing papers and giving speeches about the superiority of European systems. Now, finally, he had the ear of America's most powerful bankers and politicians. For 9 days, this group worked in complete secrecy. drafting what would become the blueprint for the Federal Reserve System. They used only first names. They swore each other to secrecy. The club's servants were not allowed to know their identities. Why all the secrecy? Because they knew that if the American public discovered that the nation's banking reform was being designed by the very bankers who would benefit from it, there would be a political firestorm. Populist movements across the country already viewed Wall Street with deep suspicion. The idea that Morgan's men were designing America's central bank would confirm every conspiracy theory and kill the proposal before it even reached Congress. But secrecy had another purpose. It allowed them to work without political pressure, without newspaper reporters second-guessing every decision, without having to defend their ideas before they were fully formed. They could debate freely, argue intensely, and compromise without public scrutiny. The debates were fierce. Should the new central bank be a single institution or a network of regional banks? How much control should the government have versus private banks? How would the system be funded? What powers would it have? Warburg pushed for a European-style central bank with significant government control. The American bankers resisted, fearing political interference. They compromised on a decentralized system of regional Federal Reserve banks, coordinated by a board in Washington, with both public and private representation. By the time they left Jekyll Island, they'd created a plan that was neither purely public nor purely private, neither completely centralized nor completely decentralized. It was a uniquely American compromise, designed to balance competing interests and fears. The plan was presented to Congress as the Aldrich Plan, named after the senator who had convened the meeting. But there was a problem. Senator Aldrich was a Republican, closely associated with Wall Street interests and widely viewed as a tool of the banking industry. In the 1912 elections, Democrats won control of both Congress and the White House. The Aldrich Plan was politically dead on arrival. The election of Woodrow Wilson in 1912 changed everything. Wilson had campaigned on progressive reform, including banking reform. But Wilson wasn't an economist or a banker. He needed advisors, and he found them in two Democrats, Representative Carter Glass of Virginia and Senator Robert Owen of Oklahoma. Glass and Owen took the Jekyll Island Plan and rebranded it. They stripped Senator Aldrich's name from it. They increased government control and decreased banker representation on the governing board. They renamed it the Federal Reserve Act and presented it as a progressive alternative to the banker-controlled Aldrich Plan. The irony, of course, was that it was essentially the same plan, just with different political packaging. But the political battle was intense. The country was deeply divided on the question of banking reform, and the divisions didn't follow traditional party lines. Progressives like William Jennings Bryan initially opposed any plan that gave bankers too much power. Bryan had spent his political career fighting against concentrated financial power, delivering his famous Cross of Gold speech against the gold standard. He viewed central banking as another tool of the wealthy to control the economy. Conservative Republicans opposed the plan because it gave too much power to government. They feared political interference in banking and worried about inflation if politicians controlled the money supply. Small-town bankers opposed it because they feared domination by New York banks. Farmers opposed it because they associated banking reform with tight credit and high interest rates. The debate in Congress was fierce. Senator Elihu Root called it the most important financial measure that has been considered by Congress in our time. Others called it a conspiracy to enrich Wall Street at the expense of ordinary Americans. President Wilson threw his full support behind the bill. He met with wavering congressmen. He gave speeches emphasizing the need for reform. He made compromises, including agreeing to reduce the number of regional banks from the originally proposed number. The critical moment came when William Jennings Bryan, Wilson's Secretary of State and the voice of progressive populism, announced his support. Bryan had been persuaded that the bill included enough government control to prevent banker domination. His endorsement brought progressive Democrats on board. On December 23, 1913, the House passed the bill 298 to 60. The Senate followed with a vote of 43 to 25. That same evening, President Wilson signed the Federal Reserve Act into law. After decades of financial chaos, hundreds of bank failures, and multiple economic panics, America finally had a central bank. The Federal Reserve opened for business on November 16, 1914, just as World War I was engulfing Europe. The timing was critical. The war would test the new institution immediately, requiring it to manage gold flows, finance government debt, and maintain financial stability during the greatest crisis the world had yet seen. Over the next century, the Federal Reserve would evolve far beyond what its creators envisioned. It would gain the power to set interest rates, regulate banks, serve as lender of last resort, and become the primary tool of economic management. It would navigate the Great Depression, though many argue it failed catastrophically in that crisis. It would help finance World War II. It would battle the stagflation of the 1970s, the financial crisis of 2008, and the economic disruption of the pandemic. Today, the Federal Reserve is arguably the most powerful financial institution in the world. When the Fed chair speaks, global markets move. When the Fed changes interest rates, it affects everything from mortgage payments in Ohio to currency values in Tokyo. Yet the fundamental tensions that shaped its creation remain unresolved. How much power should be concentrated in a central bank? How do we balance the need for expert technocratic management with democratic accountability? How do we ensure that an institution designed to serve the public interest doesn't become captured by the very banks it's supposed to regulate? The story of the Federal Reserve's creation reminds us that major institutions are born from crisis, shaped by political compromise, and designed by people with competing interests and visions. The Fed wasn't created by enlightened statesmen rationally designing the optimal system. It was created by bankers protecting their interests, politicians seeking power, and reformers trying to prevent future disasters. That very human, very messy process created an institution that has shaped American capitalism for over a century. Whether it has succeeded in its mission to provide financial stability and full employment remains one of the great ongoing debates of economic policy. What's clear is this: the next time you hear about the Fed raising interest rates or providing emergency loans during a crisis, you're witnessing the legacy of that secret meeting on Jekyll Island and that Christmas Eve signing in 1913. The institution created to prevent another JP Morgan moment continues to shape our economic lives today. The question is whether the system created more than a century ago is still suited for the challenges of the 21st century. That's a debate that started before the Fed even opened its doors, and it shows no signs of ending anytime soon.